People are back after Labor Day. There's some fireworks in the market. Sometimes people get a little bit frightened when volatility picks up. In today's video, we're going to talk about making the necessary adjustments to be profitable when volatility increases and how to trade that increased level of volatility. If those topics interest you, stick around. Hi, I'm Steven Spencer. I am a partner at SMB Capital. We are a proprietary trading firm in New York City where we trade stocks, futures, and options. So I just got back from a vacation. I'm sure a lot of you I'm talking to have also took off second half of August or the week before Labor Day, took some time off. And the market actually going into Labor Day weekend, there was a shift. And that shift happened pretty quickly. And it's continued in these few days following Labor Day as well. And what we've found over the years is we see traders struggle most when the market conditions change. We like to call that how a market is behaving a certain regime. I got that actually expression from Dr. Steenbarger, who works with our traders. Certain market regimes require certain types of trading setups, certain types of risk management, and certain types of trades. If you look at this longer term chart on the S&P via the SPY chart, what you can see is after the crash in March of 2020, we had that recovery period. Volatility started to contract a little bit. And then about 2 or 3 months following that rally, volatility had another contraction again. And if you see on the right side of that SPY chart, kind of after where I've marked it up in the middle there with a bunch of support and resistance lines, it got the ranges compressed, and we started to grind higher and higher. And in that type of regime, what we're looking for is very different than when volatility is expanded and we have larger intraday ranges. When the market was just grinding up like that in June and July, the types of trades I would look for, even in the SPY itself, were very different. For example, as the market was grinding higher, if we would gap down in the morning, I would simply look for a support level from the prior afternoon or the prior morning, put in a bid, get long, and look for it to close at the high. And that basically was really the only type of trade, for the most part, that I was doing in the SPY when the market was like that. Now remember, when the market's grinding higher, that is not an invitation to actually get short the market. In fact, generally people who try to do that will lose so much money trying to catch the top as we're grinding up, then we finally do get a change like we've had in the last week, they won't even make back the money they've lost. When the market's grinding higher, we're not looking to lay in on the short side, we're actually looking to trade that bigger picture trend. But at the same time, when the trend starts to accelerate to the upside, we will look for some sort of top. And so my timing wasn't great this year in terms of vacation because we had actually started to accelerate to the upside, got to around 350, 352 on the SPYs. I thought that was a spot to look to buy some puts. And if we had a change, in an intraday change, what does that look like? That looks like a 1% down move, maybe on a 30-minute chart or something like that. 1+% down move in an hour, something very different. And if we actually zoom in, what you can see is here's the multi-day chart, and you can kind of see that uptrend channel started to accelerate towards the top of that channel, pushing through the top of the channel, and then there was a change. And I've actually labeled the 30-minute for you here, so I actually want to go through some of the thought processes when the market does change, how to think about it from playing it on the short side, and then eventually potentially looking for a balance. And so as I just said, my timing wasn't great. I actually was on vacation when that change happened, and I didn't really check in with the market so much. And so I was not positioned short when we ran from 352 to 358. It did catch my attention. I was talking to one of the senior traders on the desk last Thursday night at 358, and we kind of joked like probably just should buy some puts in the morning because of the acceleration of the trend. So remember, you're moving higher, the trend accelerates to the upside. At that point, we don't blindly get short because there is an uptrend channel. But what we might do is look at that acceleration from 352 to 358 and say, if we do turn, how much could we pull back over the next 2 to 3 days general rule of thumb is you'll look for like a quick 3 to 5% pullback. And so if we topped out at 358, 5% pullback from there is the low 340s. So in that case, the next morning when it gaps lower to 356, I might buy some 345 puts a few days out, 345, 346. And then if it pulls into the low 340s, I can either get long the market, I can take off half of the puts. I have a lot of things that I can do there. Now, it accelerates to the upside. That's part of what we're looking for in terms of putting on a put position. The next thing that we would like to do, ideally, is see a gap down in the next morning. So for example, I'm just looking here at the chart. If 358 was the high in the SPYs, and we gap down the next morning, I'm not exactly sure where we gap to on Friday, but let's say it's in the 356, 357 area. If I'm buying puts, for this Wednesday, 345s, they're going to be extremely cheap because, again, it's a small gap down. We're still in an uptrend channel, but we've gapped lower. And the reason why we want to buy the puts is, number one, they're cheap. We also know that the priority is high is an area if we get above, we can take those puts off. And we can also use that as a level potential to watch to see if it fails. So that's on the option side. I've labeled 4 points for you here. The first one is we gap lower. We have that hard down move I've talked about in that first 30 minutes to the first hour of the morning. I want to see that 1+% down move, and then I'll look for a level to retrace. So the first hard down move actually took it into the mid 340s, so that's actually pretty extreme. So in that case, what I'll do is it's come off about $8. I'll look for like a $4 retracement, and from an intraday perspective, I'll look to short that. And what I'm always thinking is, anytime the market has a large leg down, will it retrace 30 to 50% on the time frame that I'm looking at? And I will look to short into that retracement. And the key there is shorting into that retracement is because there's a change. When we look at that uptrend channel, each pullback was modest. It was inside the uptrend channel. It wasn't until Friday when it actually broke down to the first time. And remember, one of the things that will happen when we have this first potential of a regime change, we don't know. This can sometimes be a one-day wonder if you go back over the last 3 or 4 months. Sometimes you'll just have that one day hard down. The next morning you come in, maybe it gaps down a little bit, boom, we're right back up and it resumes. We don't know on that first day if this is going to lead to a week's volatility or 2 weeks of volatility. All we know at this point is the market was behaving a certain way, and in the first 30 to 60 minutes, something changed, and I want to take advantage. Hopefully, on the gap down, you threw in some flyer puts, 3 to 5% lower, you got them cheap. When we actually go down as much as we did there on that first leg, perhaps you're going to take some off because they've quadrupled in value or something like that. Take off 25%, it pays for the trade, and then we'll see over the next couple of days, is there more downside follow through. The second point that I've highlighted in this on the multi-day here in the 30-minute is when it came into a support, when the market kind of came into a support area that I was looking at going back over the prior couple of weeks. And so one of the things that I always look for is when the market breaks down on day one and then on day two comes off really hard the next morning, I'm always looking for a bounce. And again, in this case, this is the last day of my vacation. I wasn't trading. I can tell by looking at the chart that most likely I would have been buying $1 to $2 before that morning low, just based on the psychological levels coming into that area and based on the prior support. Now this can be very tricky because just looking at the way that the bounce happened, it was crash into support, vertical move there. Those are the hardest moves to capture. Generally speaking, that next morning when it comes down, you want to see a $1 to $2 pop in the SPY, either a sideways consolidation, a retest of the morning low, or something like that. That gives you something to trade against. As traders, we always want to have levels to trade against. In the same way that I talked about putting on puts on that initial gap down on day one, I know the level that I'm thinking that I'm trading against is the high from the prior day where I can take those puts off. On day two, after we've had one day of down and the gap lower, in the morning, yes, I'm going back over the last week or two looking for a support area to buy. That's how I'm doing it. But the more conservative approach is once you put in that morning low and you start to bounce, we want to see some type of consolidation in under $1 range, even under a 50-cent range on the SPY, and then some type of bounce. That looked like it was pretty tricky there. But the good news was kind of the next morning, we actually gapped down from a bigger picture perspective, the next morning when you gap down, you want to look to buy into the prior day's low, or you want to flush through the prior day's low in a quick bounce. So the next morning, what I'm looking for, and then you can see in the pre-market, we actually did have a decent bounce. Looks like a couple of dollars or so in the pre-market. And then when the market opens, the level holds. It actually goes up a few dollars, but then in the afternoon, it takes it out, closes at the low. This is bigger picture, bearish for the market. The idea that we broke the trend on day one, came off hard. Day two, we were weak and then bounced. And on day three, we took out that low and closed below it. Now I'm starting to think, wow, we closed below the day two low. Even if we bounce the next couple of days, I'm thinking out over the next week to 2 weeks, we could have another down leg in the market. And that's just because the sellers weren't satisfied after that move. We went from 356 to 334 over the course of a couple of days. You would think that after we have a big bounce like we did on day two, that worst case we would come in, we'd get a retest, we'd close strong. And so that's point number 3 is what I highlighted, which was we closed at the low. We actually went down to 330 in the after hours. We went down another $3 from the close. So my thought process there was take some overnight, because even if we had another down leg into the 320s, we're going to have some sort of bounce. Was I thinking we were going to bounce the next day back above 340? Absolutely not. Markets just don't go up and down. It's not go up or down. They're going to go up and down. So even on a day like today, there was some strength in the morning. We came off really hard in the afternoon. We had a couple of $1 to $2 bounces. I think as we closed, I think we're probably going to close maybe $1.50 off of the low or something like that. And so what we're looking at now is today's chart. This is the intraday. And you can see yesterday we had this big bounce. We gapped up above 336. We went all the way back to 342. And the reason why I tweeted, if you wanted to short the retracement, this would be a good spot to short at 342, is because based on the action that we just discussed, we broke the trend a few days ago. We came off really hard. The second day after we had a bounce, on day 3, we failed to hold those levels from day 2, and we closed at the low. So my expectation is we're going to have some sort of retracement from the low 330s, maybe back up to 340 to 342 based on its prior support and resistance. I don't look at multi-day VWAPs, I don't look at Bollinger Bands, and I don't look at moving averages. So the 342 level was strictly based on looking at the size of the down move, the size of retracement you would expect from that down move, approximately a 30 to 50% retracement from that 3-day down move, and using levels based on the uptrend channel that we had over the last couple of weeks. And so we got 342, and so I tweeted out, if you wanted to short a retracement, thinking maybe we'll retest the recent lows, maybe we'll go into the 320s, which seems like a very good possibility over the coming days, this is a good risk-reward spot to do it. And one of the biggest mistakes you'll see when the market gets volatile like this, and the market comes off from the 350s down to the 330s, and we gap up the next morning to 336, 337, is less experienced traders won't give the market a chance to bounce. Think about how larger players are thinking and institutions are playing. Wow, the market just sold off from the mid 350s to the low 330s in a few days. I should put some money to work. We're gapping up this morning. We're above 336. Seems like the selling's done. And then you get this move. A lot of people are thinking that. So instead of us gapping from 333 to 336 and going up another $1 or $2, we end up going up $6 because a lot of institutions, a lot of larger players are thinking the same thing. We came off from all the way from here to here. We're gapping up this morning. Selling's probably done. Let's start buying. A bunch of people buy. We end up going up 2%. We overshoot to the upside. So there's a good risk reward. You're shorting at 342. Your risk is $1 or less. And if we end up failing at 342 and holding below 340, maybe we'll come back down to the mid 330s. So if we look at the right side of this chart here, I've circled 3 points for you. So I want you to think about this. What we talked about in the morning meeting today was, okay, 342 failed yesterday. We came off $2, $3. It's a good pullback. We don't know if that's going to be it. We pulled back to 338 in the pre-market. Nice, it was actually a pretty good pullback. Let's see what happens when the market opens. We do the morning meeting. We're at 339 and a half, 340, something like that during the morning meeting. Let's see if 342 fails again this morning. If it does, fails to hold above 342, we can try the short. And if we start to hold below 340, maybe we will have a pullback. Do I know if we're going to pull? Did I think at that point we're going to pull back to 334? No. What I'm thinking about is the pre-market low. So I circled that first spot there. What's the pre-market low? It's in the 338s. That's the first down leg you saw in the market. It's not a coincidence that it pulled back to the pre-market low and bounced. So if we have a $4 pullback like that, what did I just say earlier about bigger picture percentage of retracements? It applies on every time frame, whether you're trading on a 30-minute time frame or a multi-day time frame or a multi-week time frame. Markets move in waves. So that first wave was about a $4 down move. So I'm going to look for a $1.50 to $2 pop back up, and I'm going to look to short into that $1.50, $2 pop back up. And then when the second wave happens, I've circled that in the middle there, and goes back down and makes a lower low. I'm going to look for a retracement again, and it's not a coincidence that it retraced again. And you had a good entry there on the short. And then I'm going to look on the third leg. This is really important. On the third leg, does it actually hold the prior low on wave 2? And if it does, trail a stop tightly, because maybe we're going to go right back up. Or if it takes out the second leg, then go back to the prior couple of days and look for some support area. And you can kind of see, this is actually the chart, the 30-minute chart I used for the morning meeting. So you can kind of see it's marked up. We actually went all the way down to that support range on the third leg. It was a big leg, that third one. I think it was even bigger than the first one. And then we caught a bid, we bounced, and we actually went below that range before you can kind of see. I don't know where we closed, but we moved kind of back up to the top of that range. And so no one's going to feel confident about being long this market unless that range that's highlighted there, that if we close above that and start to hold above that again. I think that's probably around 335. And so that's going to be the level that I'm watching tomorrow morning. Can we start to hold and consolidate back above 335? And if we can, maybe we're just in a range here from the low 340s to the low 330s. And that's going to be this volatile range until we break one direction or the other. And so just to kind of recap it for you, we were in a certain type of regime. I was not focused on trading the SPYs. If anything, if there was a gap lower in the morning, I just throw in a bid at a prior day support, boom. That was the trade in the SPYs. I was most focused in play names, not the market overall. Again, our desk, in that regime, when there's a strong bid in the market, we are finding the most in play names, whether it's Tesla, Nikola, Red Restoration Hardware, whatever has a strong news catalyst, that's what we're talking about in our morning meeting. If you want to find the process to pick the best stocks, go to tradingworkshop.com. 2 hours, I spend 30 minutes explaining exactly what the best stocks are to be trading. In a regime like we've had for the last few months, trading the top in-play names, that's where you want to go. Those are going to give you the best risk reward. I've found over the years that if I'm in those stocks, rather than the market being a 50-50 chance of making money, it's 80% plus. In fact, the 2 months before I went on vacation, I only had one negative day. And that was the day that Tesla had earnings. I had to leave the desk early to get ready for earnings. And so if you are using our stock selection techniques to trade the best in-play names, you're going to be positive on most days once you develop trading skills. This is a different regime. And so in this regime, I'll trade the SPYs, I'll trade the Qs, I'll trade the VXX. All of these things that put things in play that we talk about in the 2-hour workshop, we talk about how to get the right stocks, how to get the top of the 3 setups we use on the desk. These things are very relevant for most times. And every once in a while, volatility expands and we can look to trade the market. And then we kind of move a little bit away from the in-play names if the VIX gets over 30, 35, 40. Hopefully you learned a little bit something about trading the market here. The main thing I want you to take away from this is when the market changes, you have to change the type of setups that you're looking at. You have to change your approach, and you have to recognize it pretty quickly, because what we found over the years is younger, less experienced traders, when the market changes, that's when they lose the most money and they dig themselves a hole. You need to be, every morning when you come in, what has the market been doing the most recent weeks, most recent days? Are things different? What would I need to see to actually adjust the setups that I'm looking for, adjust the risk that I'm taking, et cetera? And if you're doing that every day, when the market changes, you're going to be aware. Even if you don't immediately change everything you're doing, you're going to be more in a defensive posture and not rip money up, and understand that you're going to very quickly be more consistent because of that recognition.